Good morning, everyone. Greg here from MasterTrader. So yesterday was a little bit more than what was anticipated, and I guess the takeaway from that is that the news about Trump, it was unexpected. It was more of a shock, and the majority felt that it was better to get out than consider the possibility of things holding up, which they did not. So at this point, we've got the markets down quite a bit, and some are near some support, some are beginning to break. So what we want to take away here now is what's happening in higher time frames, what might happen as far as turning points. So looking at the futures here, they're down another 8 points or so. The weekly trend is still up. Now, one of the things that I've mentioned in the past, I don't know if in these videos or with our subscribers, but besides being a service to help traders and investors take advantage of positions in various stocks or ETFs and, of course, options, it's a large part of what we do is teach how to read price trends and analysis. One of the things I mentioned and pointed out to was within an uptrend, one of the things that we observe is, how much of a push there is from a turning point like this bottoming tail. And then when you get a reversal pattern, or something we call it a changing of the guard, how much of a push there is. So here's like an initial push off the November low on, again, the weekly chart. And then we had another nice push, shows continued strength. We want to see that kind of momentum. And then from there, a normal pullback to what we would call a reference point of minor support. What was the high prior to the push should provide a support level. Now, what actually happened was a shallow pullback and then a retest pattern, which is what we had right here. Now, when that happens and you get that retest, being a shallow pullback, it puts into the question, well, what happens if you don't get that push? And that's what happened here, was that you just barely pushed above that high and the momentum stalled. That's a warning sign. Now, when you get the red bar, you could have gotten another green and it could have pushed up fine. But you want to see that red bar negated, usually within the next bar, and then it continues. That didn't happen, and now you see this week has got the down bar. So those of you that are, indicator people, I am not, but I'll just show you how to read this, is that maybe you'll give up your indicators and get some extra screen space. These kind of pushes on indicators, whatever you're using there would show overbought, and if not, you're probably changing the parameters to line up with the chart. And then with a consolidation like that, it usually doesn't get overbought, then you get overbought again, and then once you make that new high, your indicator shows a lower high, or that bearish divergence as it's called. Well, you don't need the indicator, all right? Just look at the distance between the highs and you'll see that the momentum is beginning to slow down. Now, that being said, momentum can slow down. We can speed right back up again, meaning this red bar next week could turn into a green bar and off to the races. So this is where a technique that I call bar by bar analysis comes in, meaning you have a pattern such as what we have right here. And, you do your analysis and, okay, nice push. Well, this push here has stalled. What's going to happen here? Well, that has implications of a minimum of testing this low and possibly breaking through it. And if it does that, it violates the uptrend. So we have some assumptions based on what is, and then we have concepts, or part of our method that allows us to continue to update the information as it develops. So we'll see what that happens. Now, what we do in following the trend here, and so you see here's a 30-minute chart of the S&P futures right now, and you see I've got this minor support level marked off and this major support level marked off. And this is relevant to the time frame that I'm looking at. The same way with a weekly time frame, this major support level and minor support level, which has been violated, is relative to this time frame. So what I've always taught students is just look to the left of where support is or where resistance is. There's no need for drawing trend lines, right, or trying to redraw trend lines, because if this was to push through this major resistance level, it breaks the trend line every time. Right? So it's unnecessary. If you get a retracement here, this area right here, which the trend line user would say, well, this trend line is going to be resistance. No, it's just a line on your chart that you're projecting into the future. It's not really resistance. This is your resistance. If it lines up with that, well, it might line up with that, but you want to be looking at what's real, not at what, you're drawing lines on charts here, whether it's trend lines or Fibonacci lines or whatever kind of lines you're putting on there. All you need to do is look to the left and look at the price data and see what's there. Know your minor levels, know your major levels, and then from there, when you look at retracements, it's all about a retracement and how far does it get between a swing low and, in this case, major resistance. The deeper the retracement, the greater the possibility of breaking the trend. Common sense. No holy grails, no Fibonacci's, just looking at swing highs and swing lows, looking at how far prices retrace from one point to the other. Whereas yesterday, where prices had moved down, you get a big push, it could not even retrace. Rather, it created a resistance area, and then it went down again, and it could barely budge higher, and then it went down again, and then we had this little sideways correction into the close, and then down overnight, and now this sideways chop. So the markets continue to be weak here, and we can see that just by following the trend of swing highs and lows, the reactions after pushes, meaning how far do they retrace or do they go sideways? Common sense stuff. You don't have to be drawing lines all over your chart, and when you see something, somebody's doing this and then, retests and drawing and like this and so on, they obviously don't know how to just read price action. They've been a student of the hocus pocus indicators and lines and such use. Keep it simple. Professional traders keep things simple. They have a few tools that they use, and they don't cloud it up with a whole bunch of indicators. Okay? So let's take a look at the rest of the markets here. Hope you enjoyed that little lesson and it helps you. So the NASDAQ, which was extended, came down real hard. I mean, it had to happen at some point. When prices get extended as they were, accidents tend to happen. And, surprises become shocks. Whereas, when prices are, just starting out of a base, well, maybe they come back in again, but typically don't have such a violent reaction as yesterday was, or a powerful reaction. And that reaction suggests that there's more to come. You've got a big volume on a big, ugly, wide range bar to the downside. So we'll just, see how that develops. But that is the implications of what happened yesterday. The weekly is still in an uptrend. And as mentioned, looking at the distance between highs here and the next one, obviously it's smaller, so momentum did slow down, but it's not as bad as what we see in the S&Ps. Well, this has been the one showing relative strength, so that obviously makes sense. But we've got a pretty big, large red candle here engulfing, at the moment, the body's engulfing about 2 weeks. So we should, if it closes this way, and I anticipate, I doubt there's going to be any miracle that happens by the end of the week. I think in the coming weeks we're going to have some continued selling, and you'll mark off your areas of major support and minor resistance, and you'll see what the reactions is, and you'll see whether it breaks the trend. we just have a systematic process of doing this, and it, I've been doing it for decades, and it works. And that was, of course, was after trying to decipher the holy grail type of analyses that go on there. Oil stuck in that resistance area, actually holding up okay, considering the cluster of moving averages and the actual price resistance right there. But so far, it's holding up. Bonds, which I've told you, keep an eye on down here. That if they began to stabilize, the market was going to take attention of that, and if they started to move up, it was going to put pressure on the market, and clearly that's what happened. And now on the weekly time frame, what we've got here, it looks like a head and shoulders bottom, and so we'll have to see if prices can get through this resistance area here, and if they do, well, that means interest rates are going lower, which is not a good sign for the markets. So you're going to want to continue to watch this to see if bonds continue to push higher. And if you don't have the bond futures, just use TLT and set an alert up here to see if they push through that. And lastly, we have a few accidents happening. So extended stocks, shop, great, beautiful uptrend. I mean, that's more of a climactic kind of push, or a push ending a move, just because of the extent of it, and push away from any support area now. So here it is. You can see on the chart, it's down trading at 85.50-ish. So big pullback. And Cisco last night reported, and that was down about 8% last night, and it's still down thereabouts. So huge gap down in Cisco on earnings, and that one wasn't extended, but obviously the earnings weren't what was expected. So, all right, guys, that's kind of a long video. I added a bit of a lesson there for you. I hope you enjoy it. Visit MasterTrader.com. You can sign up for a trial of our service, and if you have any comments or suggestions as to what you'd like me to cover in these, Greg@MasterTrader.com. Have a great trading day.